What if I told you that inflation isn't really about prices going up? It's about your money dying a slow, quiet death. And the crazy part? This death isn't accidental, it's often a deliberate policy choice by powerful institutions. You've seen it at the grocery store. That carton of eggs, that gallon of gas, that monthly rent check, they all keep climbing. You work hard, you earn your money, but it feels like you're running on a treadmill that's speeding up, and your finish line is constantly moving further away. That gnawing feeling, that whisper in the back of your mind telling you your paycheck just doesn't stretch as far as it used to? That's inflation talking, and it's not just talking, it's eating away at your future, one bite at a time. It's the silent tax that hits everyone, whether you earn minimum wage or millions, shrinking your purchasing power without you ever seeing a line item for it on your pay stub. It's why what felt like a comfortable salary 10 years ago barely covers the basics today, even if your nominal income has increased. This isn't just an economic theory for professors in ivory towers, this is your daily reality, reshaping your choices and your peace of mind. Okay, let's peel back the layers on this silent killer. When you hear about inflation, most people picture a ballooning price tag on a product. They think the product itself is suddenly worth more. But that's usually not the full picture. Imagine money itself isn't a fixed, solid thing, but more like a measuring tape. When you hear about inflation, people often mistakenly believe the objects you're measuring are physically growing longer. A loaf of bread is somehow demanding more of your dollar. But what if it's the measuring tape itself that's shrinking? Your dollar, that unit of measurement, becomes shorter, less potent, less capable of spanning the same distance. So, a loaf of bread that used to cost one long dollar now costs two short dollars, even though the loaf itself is the same size and quality. It's not that the bread got more expensive, it's that your money got cheaper. It takes more of your now less valuable dollars to buy the same stuff. Why does this measuring tape shrink? Often, it's because there's a whole lot more of it suddenly showing up. Think about a rare comic book. If suddenly millions of copies were printed overnight, what happens to the value of your original rare edition? It plummets. Money works similarly. Governments and central banks can, effectively, create more money or make it easier for banks to create more credit, which is essentially new money entering the system. When there's more money flowing around, but the same amount of stuff to buy, the value of each individual unit of money naturally decreases. It's basic supply and demand, but applied to money itself. The more abundant something is, the less it's worth. So, when the money supply expands faster than the supply of goods and services, your money loses its punch. It's like watering down a perfectly good drink, you still have the same amount of liquid, but each sip is less potent, less satisfying. Here's the mindbender, the counterintuitive truth that 99% of people miss: inflation isn't always an accident, a natural force of the market. Sometimes, it's a feature, not a bug, in the system. Governments and central banks target a certain level of inflation, usually around 2 to 3% per year. Why would they actively try to make your money lose value? Sounds crazy, right? Like a dentist trying to give you cavities. Well, let's look at it from a different angle. Consider debt. If you owe $1 million today, and inflation runs at 5% for a year, the actual value of that $1 million you owe next year is effectively less, because the dollars you pay back are cheaper dollars. They have less purchasing power. This is great for debtors. Who is the single biggest debtor in almost every developed country? The government itself. They owe trillions upon trillions. So, a little bit of inflation actually helps them pay back their enormous national debts with cheaper money, effectively eroding the real value of what they borrowed. It's like paying off your loan with monopoly money that looks real. Your creditors still get their numbers back, but the oomph behind those numbers has diminished. Did you know moderate inflation actually encourages spending and investment? If people think their money will be worth less tomorrow, they're more likely to spend or invest it today, which can stimulate economic activity. This is the argument often made by central bankers. They want to avoid deflation, which is when money becomes more valuable over time. Deflation sounds great on the surface, your money buys more. But it can be economically disastrous, as people hoard money expecting it to buy even more later, grinding spending and business investment to a screeching halt. Imagine if you knew a new TV would be 5% cheaper next month, and 10% cheaper the month after that. You'd wait, right? If everyone waits, the economy stops. Did you know most major central banks around the world, like the Federal Reserve in the US, the European Central Bank, or the Bank of England, have explicit inflation targets? They aren't trying to eliminate inflation, they're trying to manage it within a narrow band, typically around 2%. They see the small, steady erosion of purchasing power as a necessary evil, a kind of lubricating oil for the economic engine, keeping it from seizing up. It's a delicate balancing act, an attempt to stimulate growth without letting the economy overheat into hyperinflationary chaos. So, what does this mean for you, beyond just feeling the pinch at the checkout? It means thinking differently about your money. If your money is a shrinking measuring tape, simply stuffing it under the mattress or letting it sit in a regular savings account earning 0.1% interest is like watching that measuring tape shrink faster than you can measure anything with it. You're effectively losing purchasing power every single day. Your cash is literally decaying in real terms, even if the number in your bank account stays the same. The classic advice to save your money isn't wrong, but it's incomplete in an inflationary world. The smarter question isn't just how much money you have, but what your money is doing. Is it just sitting there, silently losing value, or is it working for you, trying to outrun that shrinking measuring tape? This isn't about getting rich quick or gambling your life savings, it's about understanding the fundamental game that's being played and making informed choices to ensure your hard-earned value isn't silently siphoned away by a force you don't even fully grasp. It shifts your focus from merely accumulating dollars to actively preserving purchasing power. You need to think about assets that, historically, tend to hold their value or even grow faster than the rate of inflation, whether that's real estate, businesses, certain commodities, or even skills that remain in high demand. It's about not letting your future be silently eaten by a phenomenon designed to keep the economy moving, but often at your expense. If money itself is designed to slowly lose value, year after year, then what does saving truly mean in a world where the very unit you save is constantly being devalued?